Good morning, good afternoon, good evening, perhaps, to some of the folks. I'm Dean Pappas. I'm Global Head of Consultant Relations here at Pzena, and I have specific geographic coverage for Eastern North America. So a lot of you I know well and have invited myself, and I appreciate you joining us. You'll see on the call here several of my colleagues from Pzena. I'll just introduce our speakers, and then we can all follow up as necessary. Rich Pzena, our founder, CEO, co-CIO, Caroline Kai, a managing principal at the firm and portfolio manager, and Allison Fish, also principal portfolio manager, are going to be our three speakers today. Since you're all here, I'll assume that you've seen the proposed agenda and the accompanying text describing what we're hoping to accomplish here on this hour. So I won't spend too much time reiterating any of that or overstating the obvious, which is we're in an unusual time. However, if you look at the major indexes, they don't seem too unusual by the amount that they're off of their all-time highs, which were not too long ago. So what we do here at Pzena is not that. We're not looking at the indexes. We're looking at companies. And we asked you all to join us because, you know, we're all in this industry together, and we try to help each other out any way we can. We certainly appreciate the value of having a partnership with Mercer. So we want to spend an hour doing our part, sharing with you our research on some of the markets that we're involved in geographically, and also specifically some of the companies that we're doing research on that exhibit what a unique opportunity it is that we have right now, even while there's so much pain going on currently in the portfolio. So what we're going to do is try to stick to the hour-long agenda. I'm going to share my screen right now. Here we go. We're going to start with Rich, and he's going to take 20 minutes. We're going to do a general overview and then talk about the U.S. market. We're going to touch on Halliburton, and if we have time, a couple other companies that we think are very interesting. Following that, Caroline Kai is going to go over the non-U.S. developed markets, and then Allison Fish is going to cover what I've made up a word called specialty portfolio markets, but really what it means is those locations that we look for ideas in our international small cap and emerging markets portfolios. So with that, I'm going to hand it over to Rich to get started. Thank you.
Thanks, Dean, and thanks everybody for joining us. And it is an unusual environment, not only because value has had a tough time for an extended period of time. And if we were sitting here pre-COVID and pre the craziness in the market, we would have said that that value is pretty cheap and the spreads are pretty wide between cheap stocks and expensive stocks. And then we entered this period that I didn't think we would ever witness in our lives, where the volatility in the markets jumped back up to depression levels, and we started thinking about that as a possible outcome. And we experienced it with daily stock price moves that were 5 or 10% up or down. And when that kind of stuff is happening, you know that nobody has any idea of what to make of the world. Since then, we've obviously had recovery and the volatility has fallen. As volatility falls, basically I view volatility as a proxy for uncertainty, and probably as good a proxy as there is. And uncertainty tends to get exacerbated in companies that people are nervous about. So those would be the ones that are cyclical and negatively impacted by an economic downturn and a potentially severe economic downturn, which we are in. The only thing that we don't know is what is the extent of this economic downturn Is it something short term? And we define short term, by the way, just so we're on the same wavelength, of returning back to kind of the levels we were at in 2019 by 2022. That's how we would describe short term. And long term would be more extended, like a period like the Depression. And I think we're sort of, the market is schizophrenic in that area, wavering back and forth as to whether we're going to have a recovery that's reasonable or one that's extended. Now, when we talk about markets being only off a little bit from their high, it is completely not what we're experiencing. The companies that we've been invested in or are incrementally invested in are selling at half or less of what they sold at in their recent highs. So these are companies where revenues are dramatically impacted by economic downturn, and in particular by COVID. So when you look at these, we're granted, and we're in an environment where we only have very simple investing issues. It's not subtle. The issues are, if you can buy a stock where if it returned back to the level of business that existed pre-COVID, you could lock in high teens to or higher returns. And if it didn't come back, but came back to a much lower level, you could lock in mid-teens returns, so that your range of outcome was, the bad outcome is mid-teens and the good outcome is higher than high teens. Nobody would really ever think that that was something that you'd have to worry about as an investment. But that's what we're being offered today, with the only real investment issue being, do the companies have the resources, the financial capability to survive an extended period of depressed revenues so that they're available to make it on the other end of this, whether the other end is the normals that we used to think or some reduced level of normal. And I know a lot of people are spending their lives trying to figure out whether the future is going to be different than the present or the past. Is there some major structural change in the way the world works that we should try and set up a portfolio to exploit? We're really doing none of that. We're looking at companies that, if they return to normal, they're selling for 5 or 6 times the valuations that would be implied by that return to normal, the earnings that would be implied by that return to normal. And if they return to less than that normal, they're selling at 7 or 8 times. That's the kind of things that we're looking at. So you've seen spread charts. We have our own spread charts. I'll let Dean show those. But if you look regionally, the spread between the cheapest stocks and the most expensive stocks are massively wide everywhere. And if you can look at it on a global basis, I'm sure you've seen all these. Ours don't look different than anybody else's. The question you have to ask yourself is, what precedent exists for a short-term economic recovery, and what precedent exists for a long-term economic recovery? The short term is pretty easy. If you look at the last 50 years, at the periods of time where volatility receded, and Dean, you can put that chart on. Here's all of them in the last 50 years. One more chart. One more, yeah. Nope. And pretty much, generally speaking, as volatility recedes, meaning the level of uncertainty becomes less clear, becomes more clear, there's not as much uncertainty, markets do well and value does particularly well. It's kind of what we've been experiencing in April and May. The negative case would be, what if we go into a depression-like environment so we can look at the depression? And the depression was actually, it's eerily similar to what's been going on so far, right? In 1929, the stock market fell 34% from peak to trough. In 2020, the stock market, whether you use the S&P 500 or the MSCI World Index, fell 34%, coincidentally, from peak to trough. We had a flight to quality, just like we did in 1929. Valuation spreads were massively wide because money flowed into the safe things, which were government bonds, low vol, the growth stocks that were working, the things that are perceived to be the beneficiaries of very weak economic environment or the new way of doing business. And valuation spreads widened. So if you had in 1929, after the stock market crashed, so that was if you had invested at the bottom of the first crash and you held for 5 years and you bought the S&P Composite Index at that point in time, comparable to today's S&P 500, you would have lost about 10% a year. And if you bought the cheapest stocks, you would have made about 10% a year. Why? I think quite simply because the valuations in that initial downdraft got so compellingly wide that even with further economic weakness, they were still too cheap. And that's what we see today. So in the US market, really, I'm just going to use one example, Halliburton. I can go into more, and I'll see how long I talk before I decide whether I'm going to go into more, because I want to leave time for my colleagues to talk. But Halliburton is a great example of a high quality company that bottomed out at $4 a share. The stock bottomed out at $4 a share when oil dropped into the 20s and actually threatened to go lower. Halliburton was $70 a share at its peak. Now that peak was when oil was $100 a barrel. But in 2016, when oil went into the 20s, Halliburton stock fell to 50. This time Halliburton stock fell to 4, just to put some numbers behind this. Now, Halliburton earned $4 a share when oil was $100 a barrel. And interestingly, when oil was $100 a barrel, if you look at the amount of reserves worldwide that were being replaced based on the volume of activity that was going on in oil field services, the drilling activity, it was less than 100%, and actually substantially less. So even at $100 a barrel, we were dramatically drawing down global reserves, and we were replacing those reserves with fracking wells, basically wells that produce the substantial amount of their reserves in the first and second year that they're operating, so that you get yourself on a very, very strong treadmill to have to keep drilling activity up in order to meet long-term demand. So what did we have this time? We had a decline in demand that was short-term, combined with an environment where supply was ample. And all of a sudden, Halliburton's earnings were killed. Now, the energy industry happens to be a very interesting industry because in almost every company, it's impossible for cash flows to be negative. The only issue on oil in the oil markets, in the energy market, is whether the companies are overly burdened with debt. But operating cash flow, if you take an oil well, an oil field, it basically costs nothing to produce a barrel of oil. I know you've read all kinds of stuff that says that the average price of the cost of a barrel of oil is $20 or $30, whatever number you've read. But the reality is oil just comes out of the ground while you're lying on the couch. And the only time you spend money is when it stops coming out of the ground and you have to do something. So for an oil company to actually have negative cash flow is virtually impossible. And the same thing is true in an oil field services business. So take Halliburton. Halliburton bought a bunch of equipment and then staffed it on jobs with crew. I'm just going to make it put it in a very simplistic fashion. So the equipment is there and the crews are working. And when they finish the job, they either have another job or they don't. If they have another job, then positive cash flow is generated. If they don't, they park the equipment and they let the crews go. And so at massively reduced levels of activity, like right now, Halliburton is free cash flow positive to the extent of, $600, $700, $800 million a year this year. They're going to lose money on a financial reported accounting basis because their depreciation is very large, but they're not spending any money and they have the flexibility not to spend money. You're not going to go add trucks to build fracking capacity or even to replace your current fracking capacity when nobody is fracking. You're just going to wait. And so that's what they're doing. Now, Halliburton has $1.5 billion of cash, $3.5 billion of committed credit with no covenants. They have one debt maturity in the next 3 years of $700 million. But basically, once they've paid that, they could operate at current levels of earnings and cash flow and revenues without any financial stress for several years. Now, what happens when you stop spending money on drilling for oil and gas wells? What happens is the production starts to decline. So that's what we're seeing now. The reason the oil price is already above above the bear case that we have used to calculate the $700 million of free cash flow. We use $25 as the year-end oil price, and the oil is already $30-something a barrel. We now are looking at U.S. fracking volumes shrinking sharply in 2021, but because nobody's spending money fracking more wells. You don't go out and frack another well when 70% of the production happens in the first year you frack it, and you have no clue if the price is going to be enough. In fact, you're pretty certain that it's not going to earn enough money. So the supply, energy is one of the great businesses to invest in because the demand is mostly irrelevant. It's the supply that matters, and supply is getting a big kick, negative, which becomes a self-correcting mechanism. So at $4 a share, and by the way, we don't have normal earnings of $4. We think the normal level of earnings for Halliburton's around $2 a share. Stock was 2 times earnings. Now, our downside case for Halliburton is around $1.50 a share. So if you bought it at 4, today it's 11 or 12, but if you bought it at 4, you've locked in 50% per year forever once the market returns back to normal. That's what you did. And if it returns to less than normal, I mean, you can say half of normal. Okay, so I would have only made 25% a year forever. Today at $11, it's not quite as good, but it's still spectacularly good. That's what we were witnessing. And if you look at our portfolio, and the interesting part about what happened to us over the course of the first 6 to 8 weeks of coronavirus was We spent every waking minute speaking to the companies and re-underwriting to the companies that we had in our portfolio to make sure they had sufficient liquidity to weather an extended downturn. And that the risk reward was very much in your favor when they came back from that extended downturn. It was a unique environment that we have never experienced before in terms of access to corporate management. You know, when you are an analyst and you're doing work on a company and you want to meet the CEO and the CFO and the key division heads and you call up the IR person, it's months to get schedules coordinated because CEOs spend their life traveling and visiting their customers and their suppliers and their far-flung operations. Today, it's you call and ask an appointment and you get it the next day. And not only do you get it the next day, but you get a CEO who does not believe that any of the issues that they're facing are their fault. They're not trying to spin anything. All they're doing is exactly what you would do if you were running these companies, which is figuring out how do I make it through, making sure I minimize my cost, maximize my flexibility and liquidity, and live to make another day. And they were very, very, very willing to share those thoughts with us so we could get extremely good assessments of how many years these companies could survive a downturn. And so in the case of the portfolios, what we have are companies that are selling for 5, 6, 7 times their normal earnings power, 7, 8, 9 times a very bearish view of their normal earnings power, with extended liquidity and flexibility to make it through a downturn. So I'm going to stop and I'll answer any, well, maybe we should wait till the end for questions, but if there's anything pressing, go ahead. Otherwise, I'll turn it over to Caroline.
All right, we appreciate that. Great timing, Rich. We're right on schedule. And like I said, we have time at the end for questions. So why don't we turn it over to Caroline here? Thanks.
Thanks, Dean. Dean, do you mind switching back to the presentation, just going to the spread chart? Yeah, thank you. So in non-US developed markets, I think the themes are, you know, as Rich pointed out earlier, quite similar to those of the US. Uncertainty is leading to fairly unprecedented levels of valuation spread in pretty much every region of the world. In Europe, the valuation difference between cheap and expensive stocks, as you can see here, are basically at the widest level since the inception of the MSCI indices. Whereas in Japan, it is not far from the peak of the tech bubble of the late 90s. The economic outlook has always been more pessimistic in Europe, and it is much more pessimistic today as well. And that has translated into effectively bigger valuation discount in European cyclical stocks, despite the fact that, you know, these businesses actually are some of the most global in nature. Europe overall has, if you look at the European companies, more than half of the revenues are actually sourced from other regions of the world, such as emerging market and North America, a materially higher percentage versus what we see in the US, for instance. But nevertheless, the valuation of companies in Europe often carry a very distinct European discount, except for 2 groups. So growth is viewed as in short supply in Europe, so any growthy companies are more expensive in Europe than they are in the US, for instance. And low vol defensive companies are also more expensive in Europe, likely reflecting the fact that lower interest rates have prevailed in that market for a longer period of time. And these are the main reasons why, you know, when you look at the valuation dispersion in Europe today, for instance, it's really the most extreme versus its own history. And Dean, if you don't mind switching to page 8, if you look at where the valuations are for the cheapest quintile of stocks, really where we look for opportunities in different regions of the world, the median valuation for European companies in the cheapest quintile is under 6 times price to normalized earnings today. And that's essentially implying high teens expected returns versus the market that's closer to 14 times. And that's somewhat, this is really some of the most compelling absolute valuations that we have seen in a long time, and we would argue embeds very significant margin of safety to accommodate for a very wide range of economic outcomes over the long run. Another point that I want to just highlight is really balance sheet quality. As Rich mentioned earlier, there are really two questions. One is, is the franchise going to be around doing what it does, or maybe at a reduced scale, 5 years down the road over the long term? And can the company survive to the other end of the current cycle? And really, excess financial leverage is what leads to permanent impairment during a downturn for us as value investors, not necessarily the temporary hit to earnings or cash flow. So balance sheet repair has been the focus from our research standpoint. And if you look at a lot of the holdings that we have, from financials to industrials, the leverage levels are materially lower today than where they were going into 2008 for these businesses. And on that point, I do want to mention Japan, because Japanese companies in general are very cash rich. And that has historically been viewed as a liability, a very lazy balance sheet. That's becoming an asset in the current environment. So overall, the Japanese market has actually held up better, despite being much more export-oriented and manufacturing-driven. But longer term, we do think return has to come from sustainable improvement in the capital allocation process and active restructuring. And despite years of talking about it and some government pressure being applied, there is no sign of wholesale restructuring wave in Japan. So a big part of our research effort there is really focused on businesses where the self-help is getting activated, and the valuation doesn't necessarily reflect that change in management focus. So let me just highlight a new addition to our portfolio in the last quarter, Panasonic. So Panasonic, most of us are probably familiar with the brand through its consumer portfolio, but it's really much broader than that, and basically a sprawling conglomerate with mostly B2B focus, actually, not B2C, and some really interesting technologies and industrial solutions embedded in there. The stock price was down close to 50%. From its 2017 highs due to rising losses in a number of their subsegments, and the most prominent of which is really their electric vehicle battery business supplying both Tesla and Toyota. Now, if you look at the main activities at Panasonic, they're really, they have over 20 different divisions. They really do sort of four big things. One is make things for buildings. So that's residential room air conditioning, lighting fixtures, all the way to video management system for commercial buildings in Japan. And then they do factory automation and industrial solutions. So here we're talking about sensors in the factories to robotic welding arms or semiconductor equipment. This is really a portfolio that powers the ongoing improvement that you see in manufacturing productivity globally, and something that we think should continue for the foreseeable future, regardless of what happens to the near-term economic activities. And then there's an auto segment where they make electronic components that go into autos, infotainment system, all the way to batteries. And that portfolio is really quite well positioned for the structural shift that we're seeing from electric vehicles to autonomous driving. And then they do avionics, so they make the communication and infotainment system that you see on airplanes in the back of a seat. And this actually used to be viewed as one of the higher quality businesses at Panasonic, but has come under pressure given the plunge in aviation activities that we've seen since COVID-19. But at the end of the day, it only accounts for less than 10% of the earnings at Panasonic. So a zero scenario does not have a very significant impact on one's view of the long-term earnings outcome for the company. And already they've hired someone from Boeing to restructure the business very, very aggressively. all in all, the good businesses at Panasonic has leading market share, very strong technologies, and we think can earn over $4 billion a year in operating income on a normal basis. But it made only $3 billion in 2019 because it had lots of money-losing businesses, from solar panels to LCD screens to batteries. The company has laid out what we think are a very credible plan for either fix these loss-making businesses or exiting them wholesale, and reduce overhead costs at the same time. Now, unlike the last 5 years, where the management's focus has been on growing and spending money, now they're really focused on profitability and improving the ongoing free cash flow. We think about $1 billion in profit improvement over time is fairly achievable and possibly conservative, because it does not give the company a lot of credit for the overhead cost reduction part. And there's some really low-hanging fruits there. For instance, 1,000 people are going to retire in Japan every year. So 2020, no question, will be a difficult year. But other than avionics, we do think most of the activities that they have should recover over time. And these are core activities that power the modern economies, really just for lack of a better word, and will come back. And even with a difficult macro backdrop, the business is likely to generate modest earnings before restructuring costs for the whole year, and it's probably going to be free cash flow positive as well, given the reduction in CapEx that's being forecasted. Most importantly, they start with a very strong balance sheet, less than $1 billion in net debt with no near-term maturity, and they've got about $10 billion in liquidity on the balance sheet. So they can basically live through a very challenging environment for a very extended period of time. For all of that, we're paying about $22 billion for a collection of businesses that can generate $4 billion in operating income, with what we view as very sustainable long-term core technologies. So what's the risk here? In the short term, it's obviously how low can the earnings go because of the economic downturn. But longer term, our biggest worry would probably be the management taking a turn for the dark, to the dark side, so to speak, and start spending money like drunken sailors again. It's less a worry when conditions are tough, because this is just human nature to be conservative during difficult periods. So we're not overly concerned about that, but that's certainly something that's in the back of your mind. We're going to see them making a decision on the Tesla Gigafactory, for example, whether they'll be participating in that expansion. At $1 billion in CapEx, it's not a break-the-bank number for Panasonic. So the downside, if they fail, is quite manageable. But that is a signal on capital allocation, and it's something that we would be focused on going forward. Now, in contrast to Panasonic, I just want to mention UBS, which is something that we have owned in the portfolio for a while now. And financial stock valuations are very depressed because of really two concerns: credit costs during the economic downturn, so hence solvency for these institutions, and then the impact of low interest rates on the long-term profitability of these businesses. We own UBS because we think it offers great risk-reward trade-offs on both of these fronts. First of all, UBS' main business is really managing other people's money, not making loans. When it does lend money out, it makes basically three types of loans, right? 50% LTV, loan-to-value mortgages in Switzerland, loans to very wealthy people who have a lot of assets with its private bank, and then wholesale lending to support corporate customers, mainly in Switzerland, but also select other markets. What brought UBS down in 2008 were the securities trading businesses that generated close to 30 billion in losses. And that activity is no longer within the institution. So those business lines have been shut down at this point. When you look at the range of economic outcomes, we'll be the first one to recognize it's very wide today. But on the other hand, when you think about the type of loans that UBS makes, we think the losses on the first two types, Swiss mortgages and client loans in their wealth management divisions, are unlikely to generate significant losses. And the wholesale bank, today is about only a third the size it was in 2008, with very significant changes in the mix and the risk practices. So despite a more negative macro outlook versus 08-09, it's likely the losses this cycle is going to be materially lower than the 5 billion Swiss francs that UBS booked in its loan book between 2008 and 2009 over the course of 2 years. And the bank has about 8 billion in pre-provision earnings a year in comparison. So basically, you need to see an event that's 3 times the losses that took place during the financial crisis to effectively take out the earnings at UBS over the next couple of years. And it also has 3 times the capital that it had going into the 2008 event. So from a credit standpoint, it seems very manageable for UBS, regardless of despite the fairly negative economic outlook. And then now low interest rates, they've been living with negative interest rates in their home market of Switzerland for over 5 years now. So they know how to make money in a negative rate environment. And ultimately, net interest income is less than 15% of their revenue. On the negative side, I will mention the company has scrapped its dividend under regulator pressure. Clearly, that's not viewed favorably by the market. But the dividend is being retained, not confiscated. It will be available for distribution again once we get through the current period of uncertainty. And certainly highlights the political sensitivity that a range of businesses face today, and it's really not unique to the banks. In fact, I think, unlike the last downturn, where banks were viewed as responsible for the carnage, banks are generally viewed as part of the solution today. For instance, the Swiss banks has been very efficient in assisting with just the disbursement of government funding for small businesses. Overall, UBS trades at close to 40% discount to its tangible book value, and it's likely to keep compounding that book value over the next few years. So I think it's a very attractive risk-reward trade-off in this context. With that, let me wrap up my part of the discussion and turn it over. Well, see if there's any question and turn it over to Allison.
Thanks, Caroline. We're doing perfectly on time here, so we'll give it another couple seconds if anybody has an immediate question. Otherwise, we'll get going with Allison and have more Q&A when she's done. Take it away, Allison.
So when we switch over to the specialty markets, emerging markets, and also international small cap, we see the same themes and the same reactions by investors that we see in the rest of the world. And here we have highlighted again that valuation spread chart. You can see emerging markets in the lower right. Just one thing, when you're looking sort of across the regions, I wouldn't compare EM to the others, just given it's a much shorter time frame. And right at the beginning of the data series, you had the Asia financial crisis followed by the tech bubble. But even setting that aside, where we're sitting today, we are looking at by far the widest valuation spreads that we have seen in the 15 plus years that we've been looking at emerging markets companies. And as you can see, really in the start of 2020, that line went entirely vertical in terms of valuation spreads. And a similar theme across international small cap markets, really a flight to safety across the globe. Now, what's interesting when you think about these more far-flung markets is that from a valuation perspective, I think investors get even more wary of the cheap companies, thinking that you're really buying junk in the first quintile. It's really poorly understood, and there's a lot of fear around that. And this is actually an issue that we examined ourselves. Now, what you're looking at here is using our own valuation discipline, price to normal earnings, and going by quintile. As you can see on the left, it's from Q1 down to Q5. And Q1 would be where we're looking for new ideas for the portfolio. Our sell discipline is actually that midpoint of the universe, so in the middle of Q3. So what we wanted to examine here was whether those cheap companies were poorer quality than the other quintiles? You know, is there something about these cheap companies that is just really bad and also worse than history to drive, you know, such extreme valuation disparity? So as you can see here on the left part of the page, we looked at historic return on equity and historic revenue growth. As you can see, for the cheapest quintile, you're getting a 15% historic ROE and a 13% historic revenue growth. When you examine the other quintiles, 2, 3, 4, and 5, they actually don't look that different, right? So in terms of the historic characteristics that these companies have exhibited, the first quintile doesn't look like worse companies than the other quintiles. Now, when you shift your focus to the right side of the page, you see the valuations that you're paying for those streams of earnings. And this is where the chart is really astonishing. You know, for that very similar earning stream historically, in the first quintile, you're paying 7 times, but in the most expensive, you're paying 16 times. Now, there's a reason for this, right? Or we're not naive to the fact that the outlook for these businesses by investors has to be quite different, or else you don't get that kind of disparity. But the reality is that's always the case. You know, there's always a reason why the companies that are in the first quintile are in the first quintile instead of the fifth. There's always a controversy. There's always a concern. What's really different today, and sort of really, really different versus our entire investing history, is the width of that valuation disparity and basically the valuation cushion that you're getting in these companies. So how have we been reacting? You know, how have we been pivoting the portfolio? Really, it's about focusing on 2 different things. First, what's really, really cheap? And generally, those are going to be the more cyclical businesses because they're the ones that are feeling pain during this environment. And number 2, who can see it through? You know, I think Rich really characterized the activities of the team globally, you know, including in emerging markets and international small cap over this period, in terms of first sort of running our own numbers, understanding what bad looks like, you know, what the next couple of years could look like for these companies, given, you know, the really, really changed outlook in terms of business over the next couple of years, and understanding, using our own modeling tools, what we think that means for their cash flows and for their balance sheets. And then bouncing that off of the management teams. And I will say, you know, a company being in Korea or China or Germany, it's been no harder to get those guys on the phone than it has been the ones sitting in the US. Everyone, everywhere in the world is sitting in their, you know, their bedroom, taking phone calls at all hours. So it has been very encouraging being able to really bounce off of the management teams what we think things look like, understand from them what levers they have at their disposal, both operationally as well as on the balance sheet. You know, what conversations are they having with their lenders and that sort of thing. So just to highlight a few companies in the space that we have been quite excited about lately. First, Lukoil. So Lukoil is a Russian energy company, an asset owner. This is a bit of a distinction in our emerging markets portfolios versus developed. You know, over the last few years in our developed portfolios, we've been tilting more towards energy services and a bit away from the producers. And we can get into that if there's, you know, question around that sort of shift in positioning. In emerging markets, we have been more focused on the asset owners, and it's largely a result of a difference in the opportunity set. You don't have the same big energy services opportunities in EM the way you do in developed markets. But you do have a pretty spectacular opportunity here in Russian energy. So what's unique about Russian energy, and here we've highlighted Lukoil, but we also own Rosneft and have also added to both positions during this period, is extremely low production costs. Part of the reason why, you know, they're picking a fight here in the OPEC plus world is they have the ability to do it, given their low cost of production. As oil price is falling, their production costs actually get even more competitive, largely because most of their costs are denominated in Russian rubles, which tend to depreciate as the oil price is falling. In addition, the Russian taxation regime is such that as oil price gets lower, the tax burden gets lower as well. So that's also very protective for profitability. And in the case of Lukoil, they also have significant downside operations, which are quite helpful during this period. So, you know, great great outlook on the operational side, given a fall off in demand and a fall in oil price. Also a great outlook on the balance sheet. Very strong balance sheet, no net debt, investment credit rated. You know, this is a company that has behaved in a very shareholder friendly manner over the last few years, which has been supportive of the stock price moving up prior to this most recent period. And when we run our own scenarios in terms of what the next couple of years could look like, given, you know, very reduced outlook in terms of oil price, this is a company that remains free cash flow positive, even under our more bearish assumptions. So again, you know, exactly the type of company where we're looking to add in the current moment. Cyclical business, very cheap, stock price has been very punished, but when you look at the likelihood of dilution of shareholder value, it's extremely low, given both the operational flexibility and the strength of the balance sheet that we see here. So that's one where we've added in the emerging market space. In the international small cap space, we have also added to Rexel. This is a holding in our international portfolio as well. It's sort of on that cusp in terms of market cap space. But Rexel is a distributor of industrial equipment, sort of number 2 globally, and really spans a number of geographies. This is a company that we've owned for some time. They had actually had pretty significant self-inflicted wounds, and you can see that illustrated here in terms of the margins falling off in 2015. The pain was largely in the United States, and again, sort of self-inflicted in terms of the way they tried to build out that business, though they also did experience cyclical pain in one of their strongest markets, France, and other European markets because of just general economic weakness. But when we came into the stock, new management had joined and were restructuring the US business and really strengthening the opportunity set for the company. And over the last period, sort of leading up to this COVID pain, we were seeing that bear fruit. Same store sales were improving across the system. The restructuring in the US looked like it was really taking hold, and we were returning to growth and improved margins in that environment. The company had also launched pretty significant digital initiatives, which were having a pretty fantastic impact. You know, this is a business where a lot of your competitors are mom and pops. They're not able to make those investments. And as you can see, we have an illustration here on the bottom right of how, you know, the countries where they were able to move to more online sales enjoyed a real boost to the margin profile when they were able to do that. But in spite of all of this internal improvement, COVID hits, activity is basically halted across a number of geographies, and the stock fell quite precipitously. Now, a piece of that is also investor concerns around the balance sheet, because this is a company that does have debt. But that said, it is also a company with a very, very strong liquidity position and a balance sheet where the working capital gets liquidated as the business turns down. So as the business is slowing down, it actually throws off cash. That's an element that we think the market doesn't understand that well. Now, similar to other companies in our portfolios, we've had very extensive conversations with the management team. I think we've been on the phone with them 3 times since the middle of March. And one thing, you know, that I think is a bit unique about the current downturn is that, you know, while that working capital does get liquidated as things slow down, when you just close a branch overnight, you know, that's harder to do. So we do expect that it will take longer to see that cash flow through. So it might look a little bit different than the way that it has evolved in the past, but we still do expect that to happen. You know, another interesting development in this company as they reported earnings is because of the global nature of the business and because of the way this pandemic has hit different geographies differently and with different timing, they were able to see sort of week by week the way that shutdowns and reopenings have flowed through the top line and the effects that's had on their business. You know, I remember talking to them at the very beginning of March, you know, a lot about what was happening in Italy and France. You know, more recently, we're seeing the effects in the US. They did just report earnings, and in the announcement, they mentioned that they had already cut labor costs by 27%, which is pretty impressive. You know, they've actually matched the top line declines with the labor decline, showing a really, really impressive degree of flexibility in terms of operating efficiencies. So again, just to highlight another holding in the portfolio there. And these are the types of decisions that we're making really across the globe. Where are the businesses where valuation has fallen off a lot because it's a cyclical business, and where we believe that there's the strength for the business to see it through to the other side. So I'll just pause there. Although, since Dean went to it, I think this is an interesting chart just to quickly highlight before we get to questions. One question that we hear a lot about emerging markets in particular is, how does value work in emerging market? Does it work? What this chart is looking at is, if you have a long-term time horizon, 5 years, the returns that you enjoyed historically by investing in a value-based portfolio versus the index overall. So every dot on the page is a 5-year rolling monthly return. And the diagonal line here would be, you got the same return either way. So every dot that's above that line is you did better investing in a value portfolio. Probably a conversation that a lot of us have had before, but what I think is particularly interesting, if you can go back just for 1 second, in this moment where we're sitting at the perhaps end of a very long bull run in stock markets and people are afraid that returns may be negative for some time, what I think is really interesting about this chart is everything that's to the left of the y-axis, because those are the 5-year periods in emerging markets where you actually had negative return. Thankfully, there aren't as many of those as on the right side, but what's interesting is even in those periods, you did better if you were in a value portfolio versus in the index, which I think is particularly interesting given sort of the jumping off point where we're sitting today.
Okay, thanks, Allison. We're getting pretty close to our allocated hour. However, I know that at least 1 or 2 of our speakers are going to be available to 12:30 or perhaps beyond. If anybody has a question, please just go ahead, or you can email it to me and I'll read it.
Well, I guess I'll ask. So, I mean, most of your discussion here has been that around the idea that this is kind of a temporary business slowdown, and just assuming that everything kind of goes back to normal. What if things don't go back to normal? How are you thinking about that and incorporating that into your analysis?
Well, let me answer that. Let me answer that with an example. The best way to answer it is with our largest holding, which is GE. So really what we're concerned about in GE is probably one of the biggest concerns out there. Will anybody ever travel on an airplane ever again? So we can look at this and say, well, first of all, around 25 or 30% of airplanes are actually flying now. Passenger traffic is down 90%, but the total number of airplanes flying is still not down 100%. GE has 3 main divisions, and without GE Aviation, GE earns about 90 cents a share, assuming 0 value for GE Aviation. Stock's in the 5s. So even without its best business, with its best business being a 0, and then you look at what the other businesses are, which are healthcare related, second biggest business, that's experiencing really no substantive issues, and power systems, which is the biggest generator of electricity globally from natural gas. And I think that even in an environment where the economies are depressed for a long time, nobody's expecting power generation is going to be down by more than, you could probably be extreme and say 5%. So we sort of say, even if you wipe out the one controversial business here, GE is going to lock you in an 18% annual return, roughly, once things get back to their new depressed level of normal. So that's the downside case. I mean, you can do downside cases on all of these companies. And really, the idea of never coming back, like nobody will ever travel ever again on an airplane, it seems like a very, very, very extreme case to be thinking about, since it's not even happening today, and we're already seeing the upturn. But that's the kind of magnitude that we have. So that's what our downside cases are. Our downside in energy, since supply is critical, if demand turns out to be weaker than expected, and remember, it's not just oil, it's demand for all hydrocarbons that are relevant to what the oil and gas companies produce, you'd probably be similar. I mean, we've never had a negative year in oil demand going back for, I don't know, as far back as I can remember the data, 50, 60 years. We've never had a big positive year. I mean, oil demand, the best year I think ever was +3, and the worst year ever, excluding this year, was 0. So what are you going to put for your negative case? Let's say we put that oil demand recovers to 90 or 95% of its prior, I'm talking about energy demand. Okay, so it's 10% less drilling activity in the normal environment for Halliburton, and it takes longer to work off the excess supply. Instead of taking a couple of years, it takes 3 or 4 years. Those are the differences we're talking about. You're not talking about things where the business, where these companies have no ability to generate earnings or cash flow. And they're not in a financial position where even at the depressed level, there's not enough resources to cover the debt. So those are the downside cases that we've looked at. And I don't know what you might suggest for even steeper than that, but they mostly seem unreasonable. Even we dabbled very briefly with the cruise line industry, which you would think is the worst possible industry in the world for anybody ever doing anything ever again. And from what we hear, bookings for 2021 are running above 2019 levels. Now, I know that's a misleading number because people can cancel and get their money back. But willingness to do this, desire to go back to normal, is certainly there. So the downside case is really, you're making things up, which we do all the time. That's what we do. But when we make up bearish cases, we still can't understand how somebody could gravitate to something that's selling for 30 times. This is the thing that gets to me. What's going to happen to Microsoft if the bearish case happens, right? That we're stuck on a depression where for multiple years, 4 or 5 years, global economic activity is depressed. One of the things that you can say with almost certainty is people are not going to spend a lot of money on expanding computer systems. And yet that's 30 times earnings and above, because right now people are going to the cloud. We see the same thing in Google, right? Digital advertising has held up, but rates have collapsed. And what do you, if you're in your 4th year of an economic downturn, do you think you're spending as much on advertising as you did in 2019? Yet those stocks are behaving as if somehow they're immune. And that's what happened in the crash in 1929. Everyone thought that the things that were working were immune. They turned out not to be immune, and that's what crashed in the second wave of the depression, not the ones that had already crashed. And I think that's what that's why I think I look at this and say, if things come back to normal relatively quickly, and I own Halliburton or GE, I'm getting a triple on those companies. And if they don't return to normal, I'm getting nothing. If I invest in Microsoft and things return to normal, I don't know what to say you make. They're priced as if you're going to make very little, I think. And if things don't return to normal, Microsoft's going to get annihilated, that stock, because you don't even have to have shrinking revenues. If anybody had any hint that the growth rate was going to decline, you would never be able to justify these valuations. So it seems to me in either case, the extended period of economic uncertainty or the short period of economic uncertainty, you want to buy the things that have gotten killed.
Thanks, Rich. I haven't received any on email, so if anybody else would like to bring up any other topics, please do.
Rich, Dell, I'm trying to think about the work you've been doing and what questions we have for these very fundamental guys.
Yeah, I was just about to come up with one on the. There were a number of charts that I think Rich and others had showing the valuation spreads. So extreme levels of valuation spreads. I think the implication was, although you didn't actually say it, that the opportunity for value generally is incredibly attractive. I guess one question that I'd have, and kind of we've discussed, is to what extent are those spreads undermined because they're based on largely on earnings and book values pre-COVID, and clearly we're in a short or long term there's going to be a massive economic adjustment, and that feels like it's going to have a much more significant impact on the value side of the universe and on the growth side, just based on how both those indices or both those areas of the markets are structured. So it just feels like this is massively overstating the opportunity for value. And if we look at previous crises, maybe the tech bubble, in that instance, it was the growth side that was hit by that particular economic retrenchment. So kind of open question, and that's probably more higher level than looking at stock specifics.
Yeah, no, I actually think if this is really a different world, the growth side is where the risk really is. Because economic weakness, companies that are growing can't expect their growth rates to be the same if we're in a depression. It's just not reasonable. So I think it actually understates the spread. I'd go the opposite and say it understates the valuation spread. Remember, earnings, let's forget book value. We should forget about statistical metrics of value, because that's not value isn't statistics. Price to book is statistics. We use those things as indicators, but what matters is the earnings and cash flow generating capability of the businesses. So the question you have to ask yourself is, how much money, none of the stuff that we do is based on historical earnings or historical book value, absolutely none. Our comparisons, we use that because it's easy. And that's what everybody uses to show in their charts. And the reason they use price to book instead of price to earnings is because it's not reliant on current earnings, right? The book value, the reason price to book has always been, up until the last decade, been viewed as a more reliable indicator than price to earnings is for the reason that you mentioned. Because earnings are temporary. Earnings are what you happen to earn that year, and book value is an indicator of the underlying long-term earnings generating capability. Now that you can say has been undermined because book value isn't so relevant anymore. That's what a lot of people have written about. But there's plenty of interesting stuff that I would urge you to read. One of them that was just done by AQR.
Yeah, I read that. Yeah.
That's fascinating, right? So let's take that out of the equation. And you still see things at the widest that they've ever been. And you can also look at some of the work from Rob Arnott. That's also fascinating stuff. So it's trying to say, let's get away from all of these the statistic metrics that you can undermine and either take out the variables that undermine it, or in our case, we look at future sustainable earnings power. So is Google going to be growing if in 4 years we're still in this economic downturn? I don't see how it's even possible. Is Microsoft going to be growing? So how do you get 30 multiples? You get 30 multiples because you're growing. And so if you're not, there's no chance Microsoft's going to be at a 30 multiple. And is GE when they, even if air travel doesn't come back, is GE going to still earn, when they get their costs reduced and get everything in line, are they going to earn 50 cents a share? It's hard to see how they wouldn't. So I just think that those are the ways that we would sense doing it. You can ignore all the spread stuff if you want.
I guess kind of an associated question, which is potentially unfair given this isn't what you do, but you know, would you be comfortable buying, say, the bottom quintile of the universe because spreads are so wide? I mean, this is the question we're whistling with, because if you look at it on the surface, you say value looks unbelievably cheap, yet the flip side is there's potentially a whole bunch of stuff in that bottom part of the universe that's going to go bust. You're in the business of selecting kind of which ones aren't going to go bust, which is sustainable, but in other areas, you know, there is a more naive approach to value. And does that feel particularly dangerous at the moment or particularly attractive?
Well, look, the naive approach to value has two flaws in it. One is the bust risk, which you talked about. The other is the risk that the book value isn't adequately reflecting the underlying sustainability of the franchise. So both of those are at risk. Having said that, I would guess that there's nothing wrong with doing it on a statistical basis. When they're extreme, because obviously what we do is highly correlated with that.
Yeah,
we're just trying to avoid the things that are that seem like they're obvious that you can't figure it out. Let's put airlines into that camp. Who the hell knows, right? There's no way that you can know. You can't do. There's no research that you can do to figure out whether that's a good investment or not. If the government bails them out and doesn't take a pound of flesh, it's good. If not, it's gambling. So, but GE doesn't seem that way to us, even though they're supported, they're affected by the same fundamental underlying driver. So, I've never believed that value is a factor. Never. Value is a philosophy. It doesn't rely on price to book and price to earnings. It's correlated with those because the issue is human behavior and human reaction. So to the extent that all you're doing is playing the human reaction to avoid the stuff that feels bad and believe that that's an overreaction, yes, you can go ahead and do this very simplistically with quantitative tools and it'll probably work.
Okay, thank you.
I have to drop, but you guys please continue. Thank you, Rich.
My pleasure. Thanks.
Thanks, Jay. Okay. We're still here. If anybody else wants to ask any other questions. Otherwise, we'll get back to work.
Well, let me just say, we really appreciate that you took the time and the big crowd that you provided for us to try and showcase some of the stuff that we've been doing. And thanks for listening. You can always follow up with me with any questions through Dean or contact me directly. I'm happy to do that.
Thanks for saying that, Rich. All right.
Thank you.
Take care, everyone. Thanks for joining. Have a good weekend.
Thank you very much. Cheers, guys.